Hey, what's up, everybody? It is me, Sarah G, with the Smack, and I am back. And it seems like there ain't nothing more tread upon in this industry than the fiduciary standard. So I've got a lively crew here today, and we're going to be talking about, does the fiduciary standard really matter? Why is it important? And let's get into it. So we've got Kelly Nielsen, advice-only planner at Bravo Financial. Hey, Kelly, thanks for being here.
Thank you, Sarah.
Scott Jacobs of EP Wealth. Hey, Scott.
Hey, thank you.
Jay Adavahara, Dr. Jay Adavahara, excuse me, por favor, an independent life insurance professional. Hey, Jay.
Hey, Sarah.
Knut Rostad, president of the Institute for the Fiduciary Standard. Hello, Mr. President.
Hello, Sarah.
Dr. Stephen Lee, a lecturer at Cal State Polytech University.
Hey, Sarah.
And last but not least, Scott Salaski, my homeboy in the streets. Scott, hello, and thank you for being here.
Hello, Sarah.
So, Knut, go ahead, just take it away.
Well, thank you, Sarah. I will start with what is a fiduciary, but I want to frame it in, I think that it's most useful if we speak in terms and language that the average client could actually understand what we're saying. And I respect academics. I respect the work they do, but sometimes I'm not sure it's as useful for our purposes here. So with that opening, I'll suggest that a fiduciary is one who gives advice in trust and confidence that is truly in the best interest of the client or the beneficiary, and is based on competence and loyalty, period, end of sentence. Go on to the next question, another 30 seconds. The reason that it matters is that our entire economy, the world of investing, is based on being able to trust who we are listening to. And if that is gone, then we're in then we've got a big problem. So from a macro level, that's why it matters. And I will pause now and hand the baton back to Sarah.
All right, so the first question in our debate is, what is a fiduciary? Let's come to some kind of an understanding as a group, if possible. Who wants to take it?
So I'll jump in and say that I hear the term best interest often in conjunction with fiduciary standard when it comes to investments. Best interest to me is table stakes. The way I define a fiduciary is a person who has an undivided loyalty to the person that they're serving. That eliminates conflicts of interest. I think a fiduciary that has a conflict of interest can't really operate as a fiduciary. And I know that that is not the standard in the industry, but that's my standard.
Does anyone have a comment on that?
So actual conflicts of interest or apparent conflicts of interest?
All of the above. There are inherent conflicts of interest, and then there are chosen conflicts of interest. Inherent conflicts of interest are things like a CEO who has a fiduciary duty to both the corporation, but also to themselves. There's no reason that they have to, subvert their interests. So they have to balance that. We choose to have conflicts of interest in this industry. And that's why, to me, there is so much confusion, because there is a way to provide advice and counsel to an investor without having a conflict of interest through either product or AUM or what have you. So we're choosing conflicts of interest. There's nothing that isn't unavoidable when it comes to financial advice.
But clients may perceive a conflict of interest that isn't really there, and that could negatively
Well,
affect
give me an
client
example.
engagement.
What would that look like?
Yeah, so if the client, I don't know, if the client thinks that because you also have somebody else as a client, simultaneously, that they may think that's a conflict of interest. If the client believes that because let's say somehow they learn that you're invested, you yourself in your own account are invested in something, I don't know, I'm trying to think off the top of my head, a particular fund, a particular opportunity, they may view that as a conflict of interest. mean, there's really up to the client's imagination, right? It's just that there's different.
No,
When
Stephen,
you look
it's
at law,
not. I
for
mean,
instance,
there are conflicts and then there are not conflicts. So I guess what I'm saying is like, it's very easy in my estimation to determine what a conflict of interest. I'll give you an example. I'm a member of a community where an advisor said, "Hey, I have a client who's a friend of mine, but also in a client relationship. I need a car. She has a car and she's willing to sell it to me at a significant discount." That is a conflict of interest. And there was a lot of discussion about whether it was material or not. That's a conflict of interest. There's no way to skate around that. Now, if the way a client perceives the way someone is doing business may be a conflict, I don't think that necessarily rises to it. But I think we can absolutely define with clarity and precision what a conflict of interest is.
maybe. I used to teach and train professional fiduciaries in California, and they're not giving investment advice. They're actually making decisions for clients, conservators, powers of attorney agents, and so on. And so one of the things is that we would teach them is there are actual conflicts of interest, and then there are apparent or perceived or could be perceived conflicts of interest. Example that's not investment related is you're the conservator or guardian, and you are driving your client in their car to their doctor's appointments and back. And along the way, you decide to stop off quickly and shop for yourself, or you know that you've been having car trouble. They have tools in their garage that you can use to fix your own car, so you borrow those tools and so on. That may not be a conflict of interest, but to the public, they may view that as a conflict of interest. That's why I don't think it's so clear cut necessarily, because you can have perceived conflicts of interest that don't, as you said, don't rise to the actual conflict of interest level.
Well, I think that's probably a conflict of interest, those two examples. I don't see those as not necessarily, you're using someone else's property for your benefit. This gets into the whole concept of rationalization, which is another slippery slope. But, and the other thing too, is I just want to be clear that I do think that there are fiduciary standards that other industries and other practitioners have to uphold. My focus for today's conversation is on financial advisors, right? So I appreciate the fact that you're talking about a completely different practice area, but I would still say that those people are conflicted.
Yeah, Sarah, I'm in Kelly's camp. I think that just like a doctor or an attorney, it's doing what's in the best interest of that family you're serving or that client you're serving, 24 hours a day, 7 days a week, all year long, with no exception. Period. And there's no gray areas
Okay, so
here.
here's the problem. Everybody in the whole
areas.
world, everyone in this whole darn industry is calling themselves a fiduciary. Like, I'm on my LinkedIn debates and I got insurance agents, like, that's all they do. All they do is sell insurance. And they're sitting there telling me that they're insurance fiduciaries, and they're fiduciaries because they do the right thing for the client by selling insurance. I got insurance agents saying in these debates that you're not a fiduciary if you don't sell insurance. If you do not sell insurance, then you cannot be rightfully calling yourself a fiduciary. What do you think of this? Like, I don't think unless we get past that, what is a fiduciary? Can an insurance agent be a fiduciary? I don't think we're getting anywhere in this industry.
Well, I think that's kind of the point, right? Because the longer we stay mired in this conversation and the longer that people lack clarity, then the system can operate the way it's always operated. There really isn't going to be significant innovation. So I almost feel like often we are a circular firing squad in this business where everybody sort of stands in a circle and aims at each other. I do think that there is some merit in having a way to educate the public to say, go deeper than just, I'm a fiduciary, right? Because it's like truth in labeling. What is that? You can label anything you want, but if you have a series of questions to really hone in on what are these areas that are so crucial to supporting a fiduciary standard, then we can get there. For instance, one of the things that I've encouraged people to do when they're looking at hiring an advisor is find out how that person's compensated, follow the money. The money will tell you a lot about what you need to know. And by the way,
Kelly, but then they say, the advisor will say, the dual registered ones, right? They can say, well, I'm a fiduciary when I'm acting as
Part-time.
an advisor. And that's all they'll say. Like, they might not say, but I also get paid by commissions. I get paid by commissions or I get paid by fees. Which one would you like? Oh, well, I'd like to get paid by fees. Okay, well, I'm a fiduciary.
So that's a good point, Sarah. And at the same time, it's interesting that the insurance people you just alluded to are the ones that are saying I'm a fiduciary. I still run into people on a monthly basis that I bought an annuity and I didn't pay anything for it. Or I'm not sure how long it's good for. Like the explanation's not there, the transparency is not there, the disclosure's not there, and it's the Wild West. So of all the people to go out there and put something up saying that they're a fiduciary, I find it difficult to believe that that's the genre, the insurance folks that are putting it out there.
So I have a question. Obviously, and I'm the only insurance agent in this group, right? And that's fine. And I come from a very different background. I have been a consumer, and it's just that the path I've taken is such where I didn't want to be an agent. I ended up being an agent accidentally, right? And it's so much because, and the reason for that is because I was shopping for an insurance for myself as a consumer. And in the process, I spoke to 7 or 8 different agents from 8 different companies, evaluated over 50 different designs, which I don't think any consumer would do. They didn't have that kind of time to do it, but I'm just being analytical. I just kind of dug my heels into it. And it came to a point where the agents told me I knew a lot more about it than them. That's when it hit me. Well, why the hell am I on this side of the table? I need to go to the other side and do what is right, right? So my philosophy is, don't just sit on the sidelines and point things are wrong. Get down there and clean the garbage. If you can't do that, you have no freaking right to talk about it. It's as simple as that. Can insurance? I'm not saying you have to sell insurance. I'm not saying that you are a fiduciary only if you sell an insurance. The problem I have is I see a lot of fee-only advisors saying, oh, you don't need a whole life. You don't need a cash value life insurance. Just buy a term. Well, let's understand the concept of insurance. Why is a term cheap? It's cheap in the early years because insurance companies know very well that a person is going to die in the later stages of life. The probability of them dying, if you just pull up the actuarial tables, is less than 1% until about age 75. So what exactly are you paying for? Yep. So when you actually need insurance, you don't have an insurance. And when you don't need it, you're buying an insurance. Does that logically make sense? It didn't to me as a consumer, right? But okay, then if you now take the insurance vehicle and design it properly, look at it in a holistic concept, right? Factor in the taxation, factor in the fact that, okay, it could be a good substitute for a bond. I'm not saying it is a good substitute for a stock. And I'm not saying everyone to put a money into an insurance product only, forget about stocks. No, it's all about understanding the client needs, doing what is best. And this is where it gets very relative, right? Because an advisor, fee-only advisor might say, oh, best is invest in the market. You don't need a whole life, or you don't need a cash value life insurance. Well, if you sell a life insurance to a person who doesn't have a cash flow, I agree. That's something brutally wrong. Okay, but that's where I think there's a lot of gray area that goes there.
Jay, I think you made an excellent lecture here. And I say that in the positive sense. But I think that most of it has nothing to do with the immediate issue at hand, to me, that there's somebody who gets compensated to sell a product. Are they per se a fiduciary on the face of it? Can they be a fiduciary? And you know, I start off with Kelly. I think she's got it pretty darn well, but she's got the classical sense. And what I mean by the classical sense is you go back to, and this is not a matter of being experts in law, read 3.5 pages from the Supreme Court in 1963 and bingo, there you got it right there. You know, I know they're old white men, but, you know, they really, really had it right in terms of the nature of a fiduciary relationship. And Kelly has done the best job that I can see so far in sort of articulating that. So, Jay, I've got no question that you are smarter than most other insurance salesmen. That's part of what I'm hearing. But frankly, that's not the point. To me, it's not the point.
Well,
to me,
I think it's about taking a practical approach, right? I mean, would I like to
this is
sell?
not about a practical
Hang on.
approach.
Would I like to help clients without getting compensated on a commission basis? Absolutely, I would like to. But the problem is, there is an insurance law against rebating. What the hell am I?
But Jay,
So-
that's true. But that's really
Yeah.
not the
That's
point.
beyond my control.
Really is not the
No,
point. And it's
no,
not
it's
the
not.
point to say that if you don't sell insurance, one way or the other. The point is the larger point of, can someone whose livelihood depends on selling a product, and in a case of insurance, often in levels of opaqueness that would make us blush, can that person be a fiduciary? And the answer is no. So so I think we're off the point in terms of what the central questions here that Sarah laid out.
Well, agree. But the thing is, while we were discussing the point, the example of insurance was brought in. So obviously I had to jump in for that, right? Because it's a practical challenge that we're dealing with, and you cannot deal with abstract things.
Challenge, but the point is that nobody's most people who understand even a tiny bit don't seriously take the notion that insurance agents are fiduciaries. Now, okay, I get it. They're out there and they're saying that, and people are falling for it, and that's the reality that we live in. But I think that this discussion would be more useful if we focused on the 7% of advisors and brokers that we estimate actually are real fiduciaries, and the other 93% can't make it. And I'm using Cerulli's numbers better, for better or worse. So
here's what I would say, right? What is your solution for insurance? Propose a solution for insurance and then talk about it.
I mean, it's part, the 7% are not going to persuade or advocate or lobby the insurance industry down. That's not going to happen.
So you have no solution. You have no solution.
No, excuse me.
But you're willing to sit and comment on it.
No. Part of the solution is what actually Kelly already said. In addition to using the fiduciary word, describe what it means in a way that Main Street investors can understand. That's what we've tried to do, and we've boiled it down to 3 pages. This is what we believe the best advisors, planners who are real fee-only fiduciaries, this is what they do. And we've done it in plain terms. And we've done it in a way that we think that normal people can understand. So that's part of our contribution to this. But again, in terms of this broader conversation, I think in part we need to ignore the 93% out there and focus on what we as the 7%.
I think you should just have the 7% and have a discussion where all of you are aligned, because then there's no scope for improvement, right? I mean, you just don't want to look at the other side, because here I am as a consumer giving you the perspective of how broken down this industry is, and you don't want to listen to that. You just don't want to listen to that.
I don't know that.
I don't think that's I don't think that's a fair characterization. I think that the whole discussion is around the use of this word and the purpose for the use. So for instance, if there are insurance agents out there who are staking a claim and saying that they're a fiduciary, then they're obviously doing that because they believe that that confers some kind of value in terms of marketing or attractiveness. Now, it's completely wrong, because again, if you start with the standard of undivided loyalty, meaning there is no conflict, I don't get paid by a product, I get paid by you to provide advice and counsel that is solely in your best interest, then the 97% conflicts out really quickly. You've got one question and it eliminates most. Now, Jay, that doesn't mean that an insurance agent is bad. And that doesn't mean, in my estimation, that an insurance agent can't make excellent recommendations in the best interest of a client. But it does not mean that they're a fiduciary. And so really what we're talking about is the misguided misappropriation. Maybe it's not misguided, it's intentional. The misappropriation of this word for marketing and advertising. And that's really what we need to talk about.
Because fiduciaries aren't doing that?
Well, that to me is an interesting question, because my perception is that there are a lot of RIAs, frankly, and there are groups that have either said directly or implied that it really doesn't matter anymore. It really doesn't matter anymore. They're following the lead from the SEC. They're following the lead in part, and I don't want to get off on this one, in part from CFP board, which has just done some awful things in my view, and in part from Michael Kitces, who he skits up on his stump there and says how immaterial calling yourself a fiduciary is. So it's also internally, and I think it's a result of the 15 years that the SEC and the broker dealers have done a masterful job of changing how we think, changing how, I should say, most people think about what fiduciary is and why it matters. So I think that's part of the reality of what we're dealing with.
Yeah, that's unmitigated commitment to the status quo is what that is.
All right. So now, but the point that I hear against this from the other side is they say, okay, fine, I'm not a fiduciary. What does it matter? I still do a good job. To imply that people who aren't fiduciaries aren't as good at being financial advisors, that the care is not as high, is wrong. That's what these folks say. So what do you think about that? Scott Jacobs, you had a great point on this on the last debate.
I think when you say I do a good job, that's also like saying what I do is suitable. And I think that's a really mediocre standard of care. And so I think about, and I just talked about this earlier before we got on this call, I don't generally bring in new relationships from other RIAs. I just don't. They're all coming from the broker dealers. And a lot of that is centered around these expense ratios that could run 1%, 2%, or more. And I see it all the time. And so you could say you're doing a good job, but how do you justify the client spending an extra 10 grand in expenses? And the RIAs generally don't operate that way. It's really in the broker dealer model. And I think if you're going to do what's in the best interest of the client, you've got to look at all that stuff. And I think it's an afterthought in the broker dealer world. It just is.
But RIAs charging AUM fees is fine. They're not
No,
costing
it's
the
not.
client tons of money when you look at the future value in retirement, in the retirement account.
AUM is a conflict of interest. Bottom line, if you understand where AUM came from, then you understand it's a commission.
Now there's a lot. Yeah. I mean, there's a lot of, I would believe, I think that if we look around, we probably find a whole lot of RIAs that still charge AUM fees, right? That call themselves fiduciaries.
Oh yeah,
you're just
they
saying
say that they're commission free. I'm
Right.
saying they're absolutely, completely wrong.
I'd just like to jump in and make a sort of a differentiation. And to me, in terms of how RIAs who charge AUMs actually deliver and communicate what they do, I think there are RIAs who are as open and transparent about their all-in fees in dollars as the best flat fee, fixed fee folks. There are those that do that. And I think that mitigates a lot of the legitimate concern. However, I think of also RIAs in two other buckets. Those that are very vague about what their financial planning is, that is included in their fee. I think that's just as bad as the broker dealers. And those that just throw $2 million into into an ETF portfolio and charge 1%. I think that's indefensible at best. So anyway,
I agree. I agree with that assessment. I would characterize flat fee advisors, people who are charging transparently, but happen to be taking it out of an account through an investment portfolio. That's not AUM. AUM to me is that sort of arbitrary percentage based on whatever scale. And if you look back historically, AUM really in this world didn't exist until May of 1975, when commissions on stocks were deregulated. May Day of 1975, E.F. Hutton was the pioneer in AUM. They created a wrap fee account because why? They realized that if people didn't trade on those buy and hold accounts, they were not going to make any money. And that fee compression that came from that deregulation in 1975, which brought us Schwab and Fidelity and E-Trade and all of the platforms that we have right now, the fee on that E.F. Hutton account was 3%. And you were getting guidance and counsel from your professional on what you should do with your account. So AUM is a commission. And yet you've got an entire generation of people who have no idea about that origin story, have no idea that they're commission based, because they have been told that they're fee only because of the way this industry has operated. So AUM is a commission.
And disclosing it does, and as well as all this other stuff, doesn't matter, correct? You would agree with that?
Absolutely, because again, it's a
Yeah.
conflict of interest, right?
Right.
If a client, if I'm an AUM person, right, and I'm managing a $5 million account, and a client comes in and says, I'm taking half of it and I'm going to buy a commercial property. Are you kidding me? I'm taking a 50% pay cut and I'm supposed to advise in your best interest. You can't do it. You might be able to overcome it. You might have better angels that are willing to do the right thing. But at the end of the day, you have a conflict of interest. You do not sit on the same side of the table with a client. And by the way, you know, so did Judas. I mean,
Yeah, disclosing it doesn't get rid of it at all.
No, well, but here, let me just add one more. I mean, a dimension to that. No, I will lead the parade to say that disclosure usually fails miserably. However, I think there is a however there that actually is relevant, and that is when it comes to fees and expenses. I think investors are more focused on that than talk about disclosing conflicts. That's virtually worthless per se. But when it does come out of fees and expenses, and so I come to this point, and I've moved towards the sort of the fixed fee view, but I'm not where you guys are right now on it. If there is true and real and complete transparency, and the Smiths know what they paid in total all-in costs last year, that is a scenario which in my view still comes close to the flat fee fixed fee. Now, Kelly, in terms of should I take $2 million out and buy this commercial property? Well, of course it's a conflict of interest, and I think there are those that will say, those in the RIA world that will say that it is a conflict of interest. But if somebody's got $5 million in an account and can't figure out for themselves that nature of the conflict of interest, then I get lost in that a little bit. But
and I hear what you're saying. I get it. But again, to be a fiduciary means that it's up to us to step up and disclose that. It's not a buyer beware caveat.
No, agreed.
Right?
Agreed.
So if you're actually going to call yourself a fiduciary, you better step up and say, I have a conflict.
Well, exactly.
And better yet, not have it at all.
If someone's got $5 million, with a AUM advisor, I guess my built-in assumption, and they know the basis of the relationship, and they know the BPs they're paying, and that the effect it's going to have. But yes, someone should absolutely say it's a conflict. Absolutely. And to this point, as I've said elsewhere, I think that one of the reasons why the flat fee folks are doing so well is because of the level of transparency. You can go on the website. These are the services. This is the fee. Period. End of sentence. And
people say that, what they say though? People say that there is a conflict of interest with flat fee as well.
Of course.
Once you get paid your flat fee, what's the incentive to make?
Well, but then we start going down we start threading a needle, whatever thing you want to say. But this really does get back to the classical view, which I think Kelly was articulating, and it goes back to those who drafted the Investment Advisors Act. They knew that conflicts of interest could not be eliminated. I mean, they're actually very sophisticated in their writing and understanding this. But they also said, getting to this point, that yes, a flat fee or a single fee up front is much better than the alternative, and so they made that distinction. But they also understood that the subconscious issues around the nature of a relationship. And and again, this was written in 1940, and they really were fairly sophisticated about how they thought about conflicts. But anyway,
and to your point, Knut, I think that the industry has evolved, right? So in the 40s, 50s, 60s, it may have been difficult to have unconflicted advice. It's not difficult anymore. And the industry has not migrated there. And you've got people who, again, are invested in a certain way of doing business and want to call it fiduciary. And we're just hitting a point where that is now starting to fall apart because you can choose your conflicts. It's like a choose your own adventure, choose your own conflicts, but then you don't get to use the fiduciary label. You can't have it both ways, in my opinion.
Well, I think on a practical level, I think you're absolutely right. But as I think everybody knows around this call, on a legal level, of course, you can have a conflict, and of course, and it is a matter of how you deal with the conflict. But I don't want to go there in a sense because that just fuzzies the issue. But on a practical, higher level, I think you're absolutely right that if you're choosing to have conflicts, then you ought to go out and sell insurance. Oh, I'm sorry, Jay, I shouldn't say that. But anyway, I guess that's the way I'm looking at it.
I wonder if the fiduciary camp the 7% camp would be better off. This is something I've thought about. I'm wondering if it would be better off if fiduciaries do not place themselves in competition with people who aren't fiduciaries and sort of value laden the term fiduciary. Does that make sense? So instead of saying, well, I'm a fiduciary, therefore I'm better, instead just say, look, you need to have someone in your corner that's a fiduciary. You're going to have all these other people too in your financial life, but you need to have that one person who is fully committed to you, and I'm that person. To me, it's very different. It's different roles, and I fill this role. I'm on this side of the table with you, and everyone else, they have their right place around the table or on the other side of the table, but it's on the other side of the table. I wonder if that would be a better approach, because I think all too often fiduciaries they're just reversing the marketing tactics, right? And saying, well, I'm a fiduciary and therefore I'm better than non-fiduciaries. They're just putting themselves in conflict. That's the wrong term. They're putting themselves in competition with non-fiduciaries. And I wonder if that's really the best approach.
But on a practical basis, isn't it quote unquote sort of either necessary or impossible to avoid? To have this conflict that you're saying that we should try to get rid of. I mean,
I think it's baked into the industry, because you still have remnants of like OSJs. Just trying to think of the acronym. Long time ago, I was trying to partner with companies by bringing things to the table that they couldn't do, that their broker dealer wouldn't let them do. Most of them broker dealers wouldn't let them do, but it's a winner take all system. So everyone just views it as, well, you only have one person, fiduciary or not. And I just think that's the wrong approach. But I do think I do think that it's a holdover, right? It's a remnant of the past, which is just winner take all. There's only room for one person giving recommendation / advice, and that's what it is. I hope that we move away from it, though.
So Stephen, it's a good point you bring up, but here's the other part to it, right? So we have looked at fiduciary only in the context of conflict of interest, but there are other things that that was mentioned, which is competence, right? And what is to say that the person you're hiring as your fiduciary is competent enough? Because the way I have in my conversations with other fiduciary fee-only advisors, when I talk to them about life insurance, I can tell you that 95% of them don't understand the mechanics of it.
Sure.
It's as simple as that. So for me, okay, you tell me that you're fiduciary based on conflict of interest. Now, should we define a fiduciary based on competence as a separate title then? Because if you don't understand something and you're giving me advice on that, how am I supposed to trust you on that?
Well, the flip side of that
is a lot of times they don't even know that they shouldn't be trusted.
Yeah. Well, I also think, to go back to Stephen's point about having a team at the table. So Jay, to your point about this sounds very either or. So if when I serve a client as a fiduciary, I recognize that they need estate planning, or I recognize that they need insurance, and I go out to that professional, whether it be an attorney or a life insurance agent, and I collaborate with that professional to make sure that whatever's implemented for the client is in their best interest. So I don't think it is, I do think that we need to somehow finesse this label more effectively on behalf of consumers than we have done, because it has been very self-serving and saying I'm a fiduciary and so I'm better than everybody else. And I do think that that's, again, very misleading.
Kelly, and I think, and this is me as an observer, right? I'm nothing against, the advisors. I mean, the basic question, and I look at it from a consumer standpoint, right? I come from a different industry where I have been in a multidisciplinary team. And to me, it's all about teamwork. And here I enter the space and I see advisors or professionals beating down other professionals. And to me, that is very non-professional, right? It sometimes I just feel like puking at this whole thing. And like I said,
wait until we're finished recording.
Me too, Jay.
No, it is the truth. It is the truth. I mean, I don't want to, hide the truth. This is the reality of it, right? Let's just face it.
Yeah, but we find it disgusting. It's disgusting, some of the things these people say.
I mean, it is. I mean, I've seen on both sides of the table. In fact, just yesterday, I saw a LinkedIn post on how a fee-only advisor trashes a fee-based advisor. Really? I mean, you really want to get down to that point in a public forum? I mean, what does this tell you not only about the industry, but also about you as a professional putting down another professional? How many times have you seen a doctor putting down another doctor?
So the comment that I have about that is, you've got a systemic issue and then you have the personal issues, right? And the more that we look at each other and point the finger and go, nah, 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 the more likely nothing will ever change. Because Jay, what you're tapping into is a system of doing business that has always supported the number one producer. It's all based on GDC, and you're at the $1 million top of the table. That's a system. And so it's going to take a while for people to begin to disengage. But I can just speak from my experience. The best way to serve a client is with a team, and with having those people who have very deep expertise in certain areas. And if not everybody is wanting to step up and call themselves a fiduciary, that's fine. I have no problem with that. Some of the most competent and extraordinary practitioners probably wouldn't call themselves fiduciaries, but that doesn't mean that they're not, that they don't deserve a seat at the table. So I do think this whole idea of being exclusionary, for some kind of hot take LinkedIn post is really counterproductive.
Kelly,
that's the problem I have. And that's the problem I have.
Well, yes, you're correct. I think, or to put it this way, it's important to recognize the degree to which parts of the industry are driven by, the sales goals. So that's what I hear you saying now. But another part separate from that, to which if it were not like this, I would think of the notion of looking at someone who's selling in the context of a broker dealer very differently, and that context has to do with the opacity. And my favorite example is Ameriprise. They take 15 pages in their ADV to describe how they get paid. Now, what the hell is someone supposed to do with those 15 pages? What are they supposed to do? So yes, you could. Yes, we. Yes, we shouldn't. Beat up on people, but to the extent that the broker-dealer community is still built around being opaque, I don't know how you get around it. And I believe there are a lot of good people trying to do the right thing within broker-dealers, but I say that there's a very good chance they're not allowed to do the right thing, or it's very, very difficult to do the right thing. So I don't know how you get around that. But but I think to your larger point about having different specialties around the table, yeah. And I mean, my perception is that's where a lot of the RIA community is. I can't quantify it or anything like that, but that's where they are because they recognize that. And sure, let's have an insurance agent whose business is to sell insurance at the table, but that's to me a separate issue than whether this issue of who is rightly, correctly, appropriately called a fiduciary. That's to me at least a separate issue.
Well, I think probably not, because everything is tied. We can't we can't separate the issues because everything just goes hand in hand, and that's the
Well,
problem.
but everything is tied. But many of us have very good relationships with people who sell product, and they think a great deal of them. So that I guess I'm having a hard time thinking, what is disrespectful about looking at the guy at the hardware store who is giving me advice on lots of different things on going at the hardware store. I don't view him differently because I don't view him as a fiduciary. Frankly, I mean, I don't view him lesser because I don't view him as a fiduciary. But so, I don't know why that's so difficult here to be able to sort of apply the same thing. We know people who sell products that we respect and we trust. Part of that is because we believe they're telling us the truth and there's a certain amount of transparency, I think. So
I think it has to do with the way fiduciary is marketed too, right? It's been looked at least the way it's been marketed is it's this nice label that you need to have, or else you can't, nobody else work with anyone else who doesn't have this title, right? So that's where people are grabbing for it.
Well, yes, but
so a lot of it has to do with marketing.
Well, yes. Yes, it does. Yes, it does.
And to be honest, I think marketing can be very ugly sometimes. Sometimes the truth is never said; it's only hidden.
Well, yes, that's absolutely true. And I guess to my point, I think of a paper from Consumer Federation of America. Stephen this probably rings a bell. About 6 or 7 years ago, they did a paper showing how, on the outside, the broker-dealers continuously talked about a trusted relationship, while in legal battles, they fight tooth and nail to be considered a salesman. So, there we go. And so that's a hard one to overcome, I think.
Scott Zaleski, why are you so quiet?
To be less aggressive these days and be patient and listen. No, I'm just taking it all in. So I think kind of my opinion on it is it's interesting listening to everybody talk about it, because we're talking about it from a professional standpoint and how we're interpreting what the fiduciary standard is. And this is a small little group. Look at the whole industry. Nobody can agree on a lot of the terms we use, whether it's fiduciary or other things. And then how does the consumer even have a fighting chance to even figure out what a fiduciary is, much less other terms that are out there? So in the sense that Jay just talked about, I actually agree with what you're saying, that I think it is, unfortunately, and I don't know how we got to this point, but it is all down to the term being used for marketing purposes. And I guess in my experience, probably in the last 20 plus years, and don't quote me on this number, but probably in less than 5% of the people that I've spoken with in 20 plus years, whether they're clients or prospective clients, have ever asked about fiduciary in any context. And the ones that have tend to be people that number one, didn't become clients for one reason or another. And they kind of have this shopping list that they're supposed to ask a bunch of questions to different people that they interview. And then they just become confused and indecisive and can't make any decisions because this is what the industry's told them they need to do in interviewing advisors. And I think by default, you're throwing out numbers of 7% actually are fiduciaries. I don't know what the right numbers are. Let's say that is the right number. The 7% generally are not the ones that are out there talking about that. It's the other 93% that are using it for marketing purposes, watering the term down and confusing basically the average consumer out there. So from my perspective, I believe in the fiduciary standard. I think every advisor should be a fiduciary, whether you're a broker dealer or an RIA. It's almost impossible to do that in the broker dealer world because of the environment you're in. Knut, you made a statement of, sometimes there's good people on the broker dealer side that just want to do the right thing. Well, in my opinion, if they want to do the right thing, then get out of the broker dealer world. There's enough opportunity to do that these days. I mean, it's not like we were 20 years ago where, the tools and the systems and the support was there and you needed to sort of stay there to have, good quality infrastructure to support your clients. But today, anybody can go out there and do this. And if you don't have the experience, join a small group, join a small RIA, or, you get with somebody that just did it recently or something. But I think that the problem is just the consumer is just sort of confused by this industry. And I don't know that RIAs did that. I think it all stems back to the broker-dealer industry because it still represents a huge market for advice, or the consumers think it's advice and it's not in this day and age. And until I guess the RIA space, it's a small portion still, can agree on these terminologies and how they're applied and how they're used, and it's almost kind of useless to use them, even though I believe in them.
Well, I'm not waiting for anybody to decide. I have my definition, and I get asked whether I'm a fiduciary all the time by prospective clients. And whether they know what that means or not, I step in and I say, let me give you my definition of fiduciary. And I tell them what it is. I operate in your best interest with an undivided loyalty. There is no win-win, there's only win. Because my job is to serve you and do it in that manner. I don't sell product, I don't manage money. You pay me a fair compensation for the advice that I give you. The other thing that I'll sometimes share with them is that as a client, you have no fiduciary loyalty to yourself. You are not your own fiduciary. You're not. You have no duty to act in any manner that is in your best interest.
I think,
but I do. So it's like Pinocchio and Jiminy Cricket. So I'm your Jiminy Cricket. You want to jump out of a plane? I'm going to tell you not to, but if you want to, go ahead. Go skydiving. Not in your best interest, but knock yourself out. That's something that people really don't understand.
so Kelly,
If you're a spouse, you have a fiduciary loyalty to your spouse. You have a fiduciary loyalty to your child, but you don't have to serve yourself in your own best interest. You don't.
it's a very good point, Kelly, that you brought up. The only thing that I can see is that if we tell this to the client, it's now the psychology is going to kick in, right? They're going to end up being defensive. I think that's the practical part of it. And that's where, you have to kind of balance, and this has been one of the things. Yes, I understand the importance of regulations, and I've seen this in my previous experience as well. And you can take it to extremes, and anytime you take it to extremes, it isn't going to work. And that's where it's about finding that middle ground at that point.
It's interesting to hear the comments here because actually, in some ways, they actually reflect where the SEC is at right now. And what I mean by that is we made a big stink when the SEC basically said you could not put the fact you're a fiduciary on your CRS form. And the SEC wouldn't speak to me directly, but indirectly they said, "Oh, Canute, it's not such a big deal. Nobody reads it, and if they read it, they don't understand it." But what the SEC did say in actually in very few words, which was unusual, I think somebody regrets that because they were very clear, is that essentially that it's only being used for marketing, and so it's going to confuse people. And so, so this is sort of where we are right here. It seems in a way that it's that's where it is. So the fact that we reflect the SEC, which I think reflects the interests of Merrill Lynch, that sort of concerns me a little bit because I don't think Merrill Lynch has our best interests at heart.
I mean, there's a couple large RIAs out there still to this day. They'll talk publicly, whether they're being interviewed by the media or any other things, and talk about how they have such a great process and they put clients through this elaborate planning process and it's a requirement before you come on and so on and so forth. But then you read their ADV that the clients get, and it says, if clients want planning, we'll offer planning to them. And it's not just one or two. This is becoming sort of a trend. And I've seen this as RIAs continue to become bigger and bigger and bigger. They may have been doing some of that in the early stages and they get away from that. So what duties do they have to notify their clients that they're not offering what they offered earlier on, or that they're not offering what they're saying publicly in, again, blog posts or interviews or journalist, write-ups or whatnot. And I think to me, that's just as much of being a fiduciary. If you're out there publicly saying that, you're doing all of this stuff for a client, but then you read the ADV and it's like, well, this is all optional and not every client's getting the same stuff. Is it the client's responsibility to read that and know that you're not doing that stuff? Because again, you're supposed to be looking out in the client's best interest and providing what is in their best interest. So to me, that's not, but again, it's outside of compensation, but I guess indirectly, they get a benefit by doing that because they're doing less work. So it all comes back to economics.
Yeah, it's not just, oh, sorry, go ahead.
I was going to ask, is this just a wolf dressed as a sheep? right? Broker dealers now calling, dressed as RIAs and now doing the same thing.
To some extent, I think that's right, Jay, as RIAs. I mean, I've been doing this 20 plus years, and I've seen RIAs come and go, merge and grow and start up even since I've been in the business. And it's like, at the end of the day, it all begins to sort of take that same path. As you're a solo practitioner, most of the time in the RIA space, what I've seen is that people try to do the right thing for clients, sometimes not, but most of the time. But at the same time, as they get larger, they get away from that, and they got to put systems in place and hire people and do all kinds of stuff of now running a business versus providing advice. And again, there's not clear lines of notifying clients and explaining that we've changed and everything else. And to me, that's all part of the fiduciary. It doesn't end with fees or some benefit you're getting on a transaction or something. It's all the whole encompassing relationship. If something has changed in what you're doing, to me, just putting in your ADV is not good enough.
Well, it doesn't scale, right? I mean, it's a
Right.
relationship. It's a relationship that is started in trust, like legal trust. You had a fiduciary who was looking out for the interest of a beneficiary.
Right.
So you can't really scale that effectively. So I'm not surprised that there's a lot of disconnect between what the ADV says and what the client's really getting.
Well, I guess the
And-
other question
yeah.
that I also ask is how many clients actually go through ADVs, right?
Oh, very
I tell
few.
you
Yeah.
that.
Zero.
Yeah, very
Yeah.
few.
I can tell you as a consumer, I never looked at one of them. Like I used to get them in mail. I'm like, what the hell is this? And it's like pages after pages after pages. I have no freaking clue, right? And so I think even educating the consumer on what to look out for, what are the legal documents? So for instance, insurance contracts, right? How do you read them? Like what are the different riders? I mean, give the basic level of knowledge, because if we don't give that information, what are they supposed to understand out of it? Who the heck knows what a disability rider is? It's just a freaking term, right? It's a technical term that we understand, but a consumer probably doesn't understand that. So I think it's kind of going to the basics and telling them what these forms are, what do you need to look out for, what's a red flag, what do you need to see? I think that's probably where we need to start.
And ADVs are filtered, right? I mean, it's the information is filtered. So by the time the ADV comes out, you probably had compliance officers looking at it, regulators looking at it, giving feedback. So it's very different than the public relations person of the firm. So I think that's a large reason for the disconnect. And the other, I guess the final thing I'll say is this does raise a lot of interesting questions in terms of scaling up, as far as what do you do when your company becomes so large? And let's say you're not the owner of it. If you're the owner of it, it's, I think, easier because you make all the decisions. But if you're not the owner and your company increases in size, at a certain point, does it become untenable to still call yourself a fiduciary and be part of the firm? What if your firm goes public? Well, now you're not in charge anymore, right? Your shareholders are. So can you be a fiduciary then if your company is publicly traded? A lot of interesting, I guess, future research questions for me anyway, as an academic.
So I guess the basic question is, if a firm is focused on its growth, could that be a conflict of interest for the client?
Maybe. ABC client lists, the whole thing, right?
I'm ending this now. Everybody, thank you for being here. This was great. Everybody listening to this, if you're a fiduciary, know what the fiduciary standard is and be prepared to defend it. Be prepared to explain what operational standards you are held to that would render a higher standard of care than somebody who's not a fiduciary. That would be my suggestion as to the fiduciary crisis, how to resolve it. Anyways, everybody, thanks for being here. Listeners, please rate, subscribe, and review this show, and we will see you in the next one, folks. Just a reminder that nothing in this podcast can be interpreted as a product, insurance, or investment recommendation of any sort. Nothing in this podcast can be interpreted as legal or compliance advice. For any recommendations specific to your or your client's personal situations, please consult a consultant, advisor, or attorney.